Newsfirst Newsline with Faraz Shauketaly.
And very good evening to you and welcome to Newsline Live. Now then, in Sri Lanka, we all know that the economy is having a pretty tough time, amongst other things. But there's one thing that has sort of shown a remarkable resilience. In fact, at times, showing a spark that no one quite expects, and quite unexpectedly. I'm of course talking about Sri Lanka's capital market, the Colombo Stock Exchange. And recently, not perhaps 2 weeks ago, we had a turnover on a daily turnover, I'm talking about, of something like a phenomenal, staggering 23 billion rupees worth of shares being traded. And today, again, barely 2 weeks later, we find the market closing with a turnover of 7.5 billion, whereas it was previously, sort of tottering along at about 4 billion, just over 4. So let's find out why the market is so volatile, going up and down with almost no sort of reason or rhyme. We have as our guest today a former senior advisor at the Ministry of Finance, and also who was in the hot seat at the SEC as Director General during those bad days of 2011/2012. As Director General, former Director General, Mr. Malik Cader. Very good evening to you, Mr. Cader.
Good evening, Faraz.
Thank you very much for being on Newsline Live. Now, in 2011-12, it was what we call we did a program. It was called the Barbarians of the Stock Exchange. And we did that on the back of the extreme volatile situation of the Colombo Stock Exchange. Quite literally, thousands of small investors were caught off guard and caught on a hop, and they lost a lot of money. Equally, a handful of people made billions of money during the same period. The stock prices went up without any reason, without any rational reason, giving rise to the comparison, quite fairly I would say, even today, whether Sri Lanka's stock exchange, the Colombo Stock Exchange, is merely an unregulated casino of sorts. Is that what it is?
For us, we see a lot of similarities between 2011, 2012 and today. We see markets moving up without any, not for any fundamental reason. But the scenario is slightly different today, because for us, interest rates have been slammed to something like 4.5%, right, from 10 to 12%. In 2010, 2012, we had a interest rate regime still higher than what we have right now. So there's a lot of money which is available, right, with people. So they're looking for opportunities and avenues to come and invest. You talked about a very depressed market situation, right? Imports have been curtailed. So the importers also have a certain amount of additional cash. So we're getting a new breed of investors coming into the market and investing in the market. Now for us, market operates on demand-supply theory.
Okay.
At this moment of time, we've got a lot of money coming into the market.
From where?
Right, money which was there in the banking sector, right? So people, rather than getting 4.5% interest or 5%, they would like to invest in avenues where they can get enhanced returns. So as a result of that, there is additional money that is coming into the market.
Right.
So if you have 10 stocks, you've got 100 people with money, right? There is a demand, right? So the prices will obviously start moving up.
Yeah.
And then you will have a situation where you might not be in a position to justify the price based on its fundamentals.
Well, that's absolutely right. In terms of being unable to justify some weeks ago we had some stocks, and if you compared, the market capitalization, these companies, some of them ended up in, the top 5 position of the entire stock exchange. But when you looked at the net asset value of these shares, there was no comparison into the newcomers into the top 5 from the people who've been there comfortable in that position for years and years. So how does that happen? On what is the rationale for when there's one company who can look at their net asset value, the bottom line per value of their shares, and say this is why we are worth so much, and the new boys on the block, they come along and there's no rationale. How do you explain that?
For us, I just told you about, you see, there are 10 stocks, there are 100 people wanting to go and buy those stocks, right? Obviously, you're creating an unnecessary demand for that particular stock, right? Now, the question is, why is there only 10 stocks of that, right? A market has to operate perhaps in a different way. So one of the reasons for this is that I think the minimum public float that is there in the market has to be better enforced. What happens eventually when these shares are basically taken up by the so-called traders, right? There is an element, perhaps an element of manipulation that can be done when there are less stocks. Now, it is, for us, you might not be in a position to hear manipulation of share prices going up of some of these big blue chip companies.
Yes, and why
One
is
of the
that?
reasons for that is they have a very large public float.
Well, when you let's for the benefit of the uninitiated, what do you mean by a public float?
Public float, what we mean by a public float is the number of shares available for the public to trade. For instance, if I am controlling a company, I have 80% shares, right? Then there is 20% shares available in the market, right, as a public float.
Which means that's what the public can buy.
Hold on. If you have over 5% shares, right, it is not captured in the public float. So the public float then becomes only 15%. If a large investor has more than 5%, that has to get excluded from the public float. Right? Okay. So I have 80, you have 5, there's only 15 available, right, in the market as the public float. So when you have very little shares available, it's easy to manipulate. It is easy to manipulate the market with a very little small quantum of shares. The easiest thing to do is what they do is some of these traders, they first go and mop the market.
Which is they buy up.
They buy most of the shares in the market and create an artificial demand.
Right.
And then it's easy in a scenario like that to basically take prices up.
So they get together in a form of loose cartel, and then they pump it up.
They pump it up,
and then
you get the other investors.
When does the dump happen?
Well, it's very difficult to say when it is. Even they would know when that will happen. So they will, of course, know where the curve would be. But before that, most probably, right, these guys basically can and will exit.
And when they exit, that's when the price starts coming down.
Prices start coming down.
So it looks to me like this is not a market for the faint-hearted, meaning that investment in the stock market obviously can go up as well as come down. It can wipe you out. It can really make you. But we need to be aware, shouldn't we, that this is money that you cannot afford to lose. That's the money that you put in the stock market. And also, it needs to be an informed decision.
Yeah, for us, where investors are concerned, investors, we have two categories of we have two categories of people in the market. One, you call them investors,
right?
Quite rightly, as you say, who make informed investment decision based on the fundamentals of the company.
Right.
Then you have another category of traders who basically would invest on their gut. They come into the market in the morning, right, and they get together, they try to talk to people and see how best they could make a buck within the day. And there is also this day trading within the day.
Yeah.
That is also there. Now, trading within the day, there is absolutely no fundamentals attached to day trading.
One person who is a, shall we call, because he told me that I'm not to refer to him as an investor. He said that he's a trader. And he's also said, look, I don't know about the fundamentals. I don't care about whether it is blue chip or chocolate chip. I buy it, I trade, and if I take a loss, I take a loss, I move on to the next one. What do you call that kind of a person?
That, in fact, is not necessarily good news for a market.
No.
Right? Markets should basically work on fundamentals. The type of investor you're talking about is encouraged in markets like us, where we don't have an enforcement of this public float. For an ideal situation...
What is the rule then?
Yeah, so the rule is 80% is the rule. Right?
80%
there has
is
to be
private?
20% in the public float, which in my estimation is still not enough.
Right. What's the ideal figure?
Some of the big companies have about 40 to 50% in the hands of the public, and those companies are running very well. So the recipe for this whole thing is it is not an easy thing to enforce, right? But we should strive to do that. That is to see that a proper enforcement of the public float is made. If that is made, we will have more informed investors rather than traders. You also need to have traders. For a while, I'm not trying to say that traders are bad.
Yeah.
You need to have traders, but you need to have a good mix of it.
But if we impose that, won't we be sort of chasing away the traders and start, because they're here to make a buck. They get the whole market going. But the uninformed investor who doesn't really know the ins and outs and who's dabbling, because the interest rates are so low and because opportunities are so limited at the moment, that he's looking, like you said earlier, he's looking for a better return, better than the current maybe 4.5% you earn on interest. So if you chase the traders away, then what will happen to the market?
Well, if you as you say, if you can chase the traders away, we'll have a category of investors who will basically trade based on fundamental investment decisions, right? So whether the market will be a very flat market, then I wouldn't want to guess, Faraz.
Well, I noticed today, I'm glad you used the word, I noticed today, on a day that the market kind of expected to be quite robust and so on, because there were various splits going on, that it was rather flat. The market was very flat today.
Yes.
And I noticed that some of the stocks that were trading at more than double their net asset value was suddenly, and that recently had gone up beyond the double, had suddenly come crashing down, losing in the loss per share would have been, in comparative terms, about between 150 to 170 rupees loss per share compared to a week ago. Now that doesn't sound right to me.
Faraz, you also need to factor in I think there was a bit of a credit crunch in the market as well.
Indeed.
Brokers extended formal credit to its investors, and brokers went up to their maximum limits.
Right.
And after that, right, there was, brokers also have their capacities.
Yeah.
They went up to their maximum limits, and they wanted the investors to go to a margin provider and get their credit facilities sorted out with a margin provider.
That's something that I believe that was done in 2011 or 12 when
Yes.
You and Mrs. Indrani Sugadas, that fine and wonderful woman who was the head of the SEC, before she got probably got fed up and left it and went into retirement. Good for her. You know, you all had those rules. You all did regulate I think you made sure that the credit provider and the broker was separated. Right. They were divorced from one another.
Right.
You must have your own. And what effect did it have then?
No, those impacts are still there. So broker is also permitted to give right credit to the investors, right, subject to their capacities. But they also have limitations on their capacities. And then when they go beyond that, you might need to go to a margin provider to get your facilities sorted out. Because for us, as you say, if a stock is 2 rupees, the stock has gone up to 5 rupees, right? 50% of that, right, is going to be the credit which the investor would want to enjoy.
This is all very interesting, but it's also interesting to find out what the headlines in store for the primetime news this evening is. Let's see you on the other side of this short message.
News First, Newsline with Faraz Shauketaly.
And welcome back to Newsline Live. We're in conversation with the former Director General of the Securities and Exchange Commission of Sri Lanka, Mr. Malik Cader. Mr. Cader, welcome back to the program, and let's ask you straight away, what is the comparison, I beg your pardon, the comparison between 2011-12 and what's happened recently?
Faraz, the situation, if you ask me right now, is very good in comparison to what we had in 2011, 2012. Right. The market was more than volatile than it is now. For instance, I can give you some example without quoting names. There were shares which were trading, the value of those shares were 10 rupees, but in a week's time were trading at 150 rupees. There were shares which were 75 rupees, which were trading at 420 rupees, right? In a couple of days. So the market was very volatile. I don't see that kind of a volatility in this market. I'll tell you the reason. I don't want to take the credit for that, right? Because at that time, there were very, very harsh regulatory actions we took where we became extremely unpopular as a result of that. But by taking those rules, today, the credit situation in the market with margin providers have been regularized. We didn't have a credit situation there in the market, right? Prices moving up, we put handbrakes. We were criticized, we were heavily criticized for putting handbrakes, right? Now, we had to do that because prices moving in the wrong direction at that time.
So some of those handbrakes are still in place?
No, now there are no handbrakes. Fortunately, right, we have not seen that element of volatility in the market.
Why was the trading halted recently on midstream during the day?
Yeah, no, generally when the share prices or the indexes move up or down 5 to 10% in any market, right, it's like a cooling off period, right? You cool it off by about a 10 minutes break or a 15 minutes break. We don't know the reason why it happens. So when there's a cooling off period, right?
Do you think what's happening is fueled by the arrival or the imminent arrival even of captive funds like the EPF and the ETF?
That's a good thing, in fact, for EPF and ETF for the captive funds to come in the market. All this time we didn't have the captive funds.
But how can it be good? For example, when back in 2011-12, the EPF purchased shares that had artificially high, there was without rationale, the price, like you said before, 45 rupee shares was trading at, or 35 rupee was trading at 400 and something. We had one business, the share price, I remember, was in the 40s, below 45, and they pumped it up, or somehow mysteriously went up to 65 or 62. It was sold. The purchaser was the EPF funds. And then, lo and behold, within a fortnight, it was back down to 40. And so, it's no good saying, look, these are unrealized losses and so on, because we can pick another point. The fact is that do these companies pay a fit and proper and commensurate dividend to the shareholder, in this case maybe the EPF.
For us, you're right in saying in 2010, 2011, there were instances where the captive funds came into the market and bought very unrealistic stocks.
Yeah.
That for a while doesn't mean that you shouldn't prevent of those captive funds coming into the market now, right? If they come with the same behavior they had previously, right, you have a point, right? We have to do something. But if they come, right, looking at basic fundamentals and investing, I think it's a good thing for the market, because captive funds are necessary for a market. You cannot keep them away, because those captive funds, there are investors in those captive funds for us.
Right.
Right? They also have to benefit. If there's a run, they have to benefit from the run. If there's an economic upturn in the country, those captive funds will have to benefit. Why should they be kept out? And those are EPF unit holders,
Yeah.
right? So people who basically put their contributions. If there is a benefit, certainly they have to benefit. But I'm with you,
Yeah.
right, in saying
But some of these
if there are
stocks-
bad eggs, the investment management at the EPF will have to be corrected. And I think now there is a fair amount of good news, right, where that is concerned, where the captive funds
Mr.
are
Cader,
concerned.
you know, in 2010, 11, 12, we had people saying, you know, these are patriotic billionaires. They invested in the stock market because they had confidence in the market. We were winning the war, blah, blah, blah. And, you know, the market rode and everybody was very happy about it. And personally, these people made money. You know, individually they made money. But my point is, the ETF funds, the people's monies, did they make, you know, forget the share, the capital appreciation of the share itself for a moment. Did they make a return in terms of the dividends paid to the shareholder, in this case the EPF? Was that commensurate with the amount of money they spent in buying the shares? If a share was worth 50 and they bought it for 200, I'm just taking it a hypothetical thing. If it was 4 times more, 3 times more, did that company pay out a dividend that was commensurate to that investment made?
Yeah, that's an informed investment decision the fund manager has to make for us. For instance, if a share was 50 and he bought it at 200, he has to be responsible for that investment decision, right? So I think previously some of those fund managers had to basically explain the reason.
Do you remember
why they had to do that, right? So now hopefully the stables have been cleaned, right? And there is good fund management activity with these captive funds, and captive funds are necessary for the market. You cannot only
well, yes,
have
they're
retailers.
necessary, but they're necessary. But we need to find out whether
No, with proper
we've
regulation.
got 2 minutes. We need to find out whether these pussycat stories, like during the bond scam, we found that the chief dealer or the chief trader at one of these captive funds, he had a tummy ache. Another day he had a headache. He didn't turn up, so they didn't buy anything, and therefore we had to do something. So we bought it on the secondary market. Those are good pussycat stories, you know. You know, there's a saying, this konde bandapuchinu kata, you know.
So that's right. For us, you're right in saying so. So we need to have proper and good regulation for that kind of pussycat stories.
And what
right?
do we do with these so-called patriotic traders?
Yeah, so
do we shove them behind bars at Malik Cader?
Yeah, so if we have such kind of traders who are basically being accused of manipulating the market, I think the SEC has a fair amount of regulation to take them to task.
Don't you think that's treasonous when they use the public funds and misuse the public funds? Isn't that treason?
Of
Shouldn't
course,
they
yes.
be hung and gall-faced
Yes,
and all that?
if it's public utilization of public funds for wrong purposes, yes, I'm with you on that. But
Right.
for a while, it doesn't mean that we should cut the captive funds away from the market. We need to have them in the market with proper regulation and control.
Do you think the SEC is being regulated properly? Do you think they're doing their job properly?
Well,
what did the previous government
right.
do?
From a point of view of the SEC, for us, it is not easy regulating a market like this, because market manipulation is not done by one or two people.
Yeah.
It's a group of people.
Yeah.
Sometimes can be 500-600 people together. So they need to, the SEC needs to do a lot of research, right? A lot of investigation, techniques are necessary. And I think the tools are there. So you cannot find a solution within a day or two for these offences.
Malik Cader, thank you very much for being on Newsline Live. That's the way it was. Now it's time for the primetime news from News First. Thank you for watching. Take care, and as always, God bless you.